Hello everyone and welcome to our presentation today. This is Taxmageddon. We've got some really large changes happening in our United States income tax code and really impact us as business owners and investors. And I congratulate everyone for taking the time today to really get educated on how these changes apply to you. This is professional real estate investor David Campbell from HassleFreeCashFlowInvesting.com, and we have a terrific faculty today who are really experts in understanding the tax code and helping us understand how to use that tax code to our advantage. So what today's about, getting into relationships with people that can help you improve your business. Keystone CPA and UDirect IRA are two vendors that I have been very successful using, and they've really helped my real estate development business and real estate syndication business and investing go to the next level. And so I really appreciate working with them and creating educational content for our listeners and our clients. So just want to make everyone feel comfortable. This is not a sales pitch. There is nothing for sale today. This is really just an educational event and an opportunity to get into relationships with people who might be interested in using our services at some point in the future. So three different companies. We each have our own unique specialty in terms of what we bring to the table in terms of business, financial, and tax consulting. But we also want to make it clear that this is not legal or tax advice. This is really an educational event, and we're all here to learn and figure out how to apply these ideas to make our businesses more profitable. So what we do is really try to understand what we do at Hassle-Free Cash Flow Investing, I should say, is help our clients create an assessment of their financial goals, specifically their real estate investing goals. Help the clients assess their resources, put a strategy together to achieve those goals, and then we help the clients go into the tactics and implementation of those goals. When you're putting your strategy together, it's so important to understand the tax consideration of that. And we can work with our clients to really think through some of the considerations for tax, but ultimately everyone's tax situation is unique. And that's where you need to have a strong tax advisor on retainer to really understand when we put a particular investing strategy together, how that strategy will impact ourselves in our unique tax situation. So I'd like to introduce, at this time, would like to introduce Matt and Amanda from Keystone CPA. I've had the pleasure of working with them for almost a year and been really smart, knowledgeable advisors, really understand what my challenges are as a real estate investor, and have really encouraged them to bring this message of these upcoming tax changes to our clients so our clients can be really prepared with how drastic the 2013 tax changes are, and hopefully together we can come up with some strategies to make that tax burden less upon you. So welcome to our call today, Matt McFarland and Amanda Hahn.
Thanks, David. Really appreciate it, and it's great to be here. And we're looking forward to kind of providing hopefully all this great, valuable information to everyone.
Yeah, and before we start, I just want to make sure we're clear. Like you said, David, there are a lot of tax changes coming up, none of which are good as it currently stands. But today's conversation is going to be more than just the doom and gloom. We're also going to be going over, in addition to the tax changes, some strategies. Because that's really what is on everyone's mind, is we know taxes are going up, but what can we do to protect ourselves? So we want to start with going over some of the statistics currently as it stands with the low tax rate. ABC News came out, this was even actually a few years ago, that said that the average American spends more money in taxes than they do in food, clothing, and shelter combined. Which is really, really incredible if you think about it. But really, you got to see, well, how do they come up with that statement?
Yeah, I mean these are the numbers behind the statistics. So right here you can see we're just showing you what the current rates are for 2012 and what they're going to go up to in 2013 in what is it, less than 5 months now. So you can see that the highest federal income tax rate is set to go up by about 4.6%. You know, if you happen to be lucky to live in a state like we do in California, it's got a high state income tax rate of 10%. You've got capital gains taxes to look at. If you work for yourself or have your own business, you've got to think about payroll taxes. A state tax environment totally changing. So it's a lot of things going on, a lot of movement. But you know, the big thing here also is, one big takeaway is, okay, they're raising current rates, but what are some other quote-unquote politically correct ways to increase taxes besides just raising the rates?
Yeah, they're taking away a lot of deductions, phase outs, changing in the tax brackets, and those are more stealth ways, if you will, of essentially increasing our taxes. Because a lot of times when you hear politicians talking, and you're hearing a lot right now in the media, is people are talking about tax rates, increasing tax rates. But a lot of what you're not hearing about is all the technical stuff that's within the tax code in terms of what are the other takeaways that the government is looking at from a deduction side. And one of our favorites, well, not favorites, but favorite topics of discussion, which I know on today's call we have a lot of people who are interested in growing their wealth and investing in real estate. So there's actually 2 brand new taxes, and when we say brand new, we mean completely brand new, just something that was thought up by the IRS. There's 2 new taxes. The first one that we want to talk about, for any of you who are either currently investing in real estate or plan on investing in real estate, or actually investing in anything in general, okay, if you want to use investment as a way to grow your wealth, which we always recommend you do, right, because you can't just be, you know, working yourself to death to build your wealth. This brand new tax that's coming out is called the Unearned Income Medicare Contributions Tax. Now, I know that's a long title there, and it's very misleading because typically when you look at it, you don't really know what that is. You know, what does it mean to have a tax on Medicare contributions? If I don't contribute to Medicare, am I not subject to this? Or maybe if I'm not receiving Medicare benefits, maybe I don't have to pay this tax. Well, you'd be surprised. This tax is actually a tax on investment income. And what do we mean by investment income?
Yeah, just kind of the more frequent ones we're going to see is interest. So if you're a real estate investor investing in trust deeds or notes and you're earning interest income.
Or if you're not a real estate investor, you just, you know, are someone who wants to put your money in the bank or buying savings bonds. I mean, these are interest income. Right. So any type of interest could potentially be subject to this 3.8% unearned income Medicare contributions tax.
Say that again, huh? Also, dividends, royalties that you'd be earning, rents, that's a big one for our real estate investor clients. Gain on sale of real estate, if you're going to sell your rental property, the gain from that could be applied to this. If you sell your primary residence and you actually have taxable gain from the primary residence, that could be subject to this new tax. So there's a lot of things. And another big one is just income from passive activities. So you happen to, like Amanda was talking about, you happen to be maybe you're an entrepreneur, you invest in multiple businesses that you're not, you know, let's say you're not actively involved in the business, but you're just receiving distributions every year, profit distributions. That profit could be subject to this new tax as well. So basically they're just kind of getting across the board on what are people investing in, and can we tax some of the 3.8% on that? Mm-hmm.
And this is in addition to the capital gains tax and the income tax that we talked about earlier on a previous slide.
Now, one thing to keep in mind here, as you can see on the slide, is that this does affect only taxpayers with adjusted gross income if you're single over 200 or if you're married over 250. So obviously in that example, there is a marriage penalty here. Mm-hmm. So, you know, obviously if your AGI is below 200,000 or 250, you know, theoretically you don't need to worry about this. But for a lot of people, this is going to be a real life scenario that they're going to have to plan for and strategize for, and ways to minimize this tax or get around the tax.
Yeah, so in short, this is not a tax on Medicare contributions or for people who are receiving Medicare benefits. It's basically just a tax on investment income from various sources that someone would be generating. And later on, we're going to talk about some of the strategies and some specifically with respect to real estate too, on how you can protect yourself from this new tax. Okay, the other one, kind of like...
The other brand new tax coming out.
Yes, the evil twin to the Medicare contributions tax is called the hospital insurance tax. Another brand new idea that came about a few years ago, and contrary to popular belief, it's not a tax that's assessed on hospitals or insurance companies. Wouldn't that be nice?
That would be nice, yeah.
This tax is actually assessed on people like all of us here today on this call. It's another 0.9% and affects the same taxpayers, single 200,000 or above, or married filing joint 250 and above. And this, we said this is the evil twin. The first one we're talking about investment, tax on investment income. This one is taxes on earned income. So what is earned income? Well, it's basically everything that's not investment income, okay? So we're talking about W-2s. This may impact W-2 earners. If you're Schedule C, a sole proprietorship, that's also earned income, self-employment income, basically anything that you're doing actively to generate income, you would potentially be subject to this 0.9% on top, again, on top of payroll taxes, income taxes, self-employment taxes that you're paying already. So this is, this is pretty significant. And one thing I want to address, because we've spoken to a lot of clients about this. Sometimes people say, well, we don't know if that's going to happen yet. It's, potentially happens in 2013, but we'll see what happens with the election. This might not be something that comes about. Well, currently as it stands, this law is scheduled to take into effect in less than 5 months. Okay, so in about 4 months, effective January, this is set to take place. As far as I've seen and kind of following the media and the elections, this actually hasn't been something that's being addressed.
No, it's not.
And I really haven't seen anyone trying to, what's the one I'm looking for, repeal this potential tax increase. So,
the funny thing too is that it's getting a lot of publicity recently, but as you mentioned, this is actually a couple years old. They came out with this a couple years. It's just not going into effect until this coming January. So obviously now everybody's talking and thinking about it.
Yeah. So between the 3.8% and another 9%, you can see how 0.9%. You can see how important it is for us to make sure that we get some tax planning in place. This is a really interesting slide. I just wanted to show, I think a lot of us would be fairly happy with, making $500,000 of income per year. But if you really take a look at all the taxes you're paying to the IRS, to the state, to the payroll, investors' taxes, capital gains, on average, you're left with just a little under $200,000 before you're able to spend your money. Before you go to Costco, before you put gas in your car, before you, buy groceries and put food on the table. And so it's really amazing when you take a look at what the cost currently is of taxes. And, when we talk about wealth building, because I know that's very important for everyone here today, when we talk about wealth building tax, the tax drag a lot of times is the biggest hindrance to wealth building, because in a scenario like this, if we make $500,000, instead of paying, $200-300 of it to taxes, if we can use that to invest, that significantly increases the growth potential. I know, David, you typically go through an analysis about tax-free or taxable investments. And for those of you who haven't seen it before on David's presentations, it's an extremely powerful example that he goes through.
You were just showing that we spend almost, in that case, well over 50% of our ordinary income in taxes. And one of the strategies that I'm sure that the clients should be aware of is that ordinary income is the worst kind of income there is. And so as real estate investors, we're doing our best to reclassify our income to be capital gains income when possible, to be tax-deferred income through the appreciation of a real estate asset. having that depreciation shelter creating phantom losses for us. So when people are looking at how they make money in real estate, when they focus on just the ordinary income perspective, that's important, but I really encourage people to understand how they can make money in real estate through tax shelter. And so there's also ways to shelter your ordinary income through real estate, where you might actually lower the income tax on your salary because you own property. And so there's so much to talk about, and I don't want to slow the momentum of the call down, but that pie graph was just so powerful to me that there's no way you can get ahead in life if you're giving away that much of your money in taxes.
Yeah, absolutely. I mean, that you brought up a good point about, if you can, you don't want to convert your ordinary income to capital gains income. I was just talking to a client yesterday that, currently, for those of you know, right now the capital gains rate for federal is at 15%, same rate for dividends that you earn. So we were talking to a client yesterday that's going to have to take a big dividend from their corporation, and just showing the example of, well, you may want to do that before the end of the year, because next year that dividend rate goes out the window, and for them making $200,000, the rate they would pay on the dividend now is 15 versus next year is easily 35% or higher. So that's a perfect example of what you're talking about, is trying to find the best rate for the money that you're making.
Yes, and whenever we talk about different types of income, a lot of times just in looking at ordinary income versus capital gains income, you can easily see a swing of maybe 30 to 35% from taxpayer to taxpayer. And so, that's a good transition into our next slide, which is starting out on the strategy side. So we know about the doom and gloom. We know what's coming up. We know who's going to be impacted. So what are some of the things that we should be looking at right now? What are some of the things we should be working with advisors on right now to make sure we're protected? And I think, Matt, you shared a really great example about someone who is maybe considering, should I, if I invested in Apple stocks, should I be redeeming those now, or should I wait until next year? Which one is much better for me? Well, and of course, it depends on the person, but in that specific client example, it would be much better to redeem it this year, because right now the highest capital gains rate is still only 15%. Next year, it potentially increases to 20%, plus there's another 3.8% of investment taxes.
Right, so if you are somebody that is going to be subject to that extra 3.8%, all of a sudden your capital gains rate goes up by 8.8%. So one of the first strategies that we talk to our clients about, and always comes to mind, is looking at harvesting capital gains. And this could be on the sale of stocks, this could be on the sale of real estate assets. So you may want to look at, does it make sense to sell them this year versus next year or 2 years later, whenever you're considering, what the market's going to do and when you think you're going to be able to sell that property. Now, this brings up a great thought, is that a lot of times we obviously, one of the strategies we always look at for tax planning is, can we defer paying taxes as long as possible? Well, this is the exact opposite, right? You may not want to defer taxes to next year or the year after. Last year we were working with a client that was selling a property, and it was going to close in, I think it was December 15th of 2011.
It was a rental property?
It was a rental property, and for her it was going to be about $75,000 of gains. So that was going to be...
That's nice. I like that.
Yeah, it was a good profit, but it was also going to, obviously she's going to have to pay some taxes on it. I think her number was about 20, 25 grand, something like that, depending on, her numbers. But so we talked to her last year about, well, if you can delay the close of that property for 2 weeks to January 1st, January 2nd, that's going to defer the taxes due on that property by an entire year. Now, for her, rates weren't going to change, so the taxes weren't changing, but she'd have a whole extra year to pay that tax. But going back to our example here, this year that strategy may not work for everybody, because next year the rates actually might, in effect, go up. You might be paying the extra 8.8% on the same amount of money.
So what I hear you saying is, one strategy is we're trying to classify our income in the most favorable tax environment. And so the strategy you're talking about is what year do you want to pay it in? Because if you have control over your income, as a business owner and an investor, I can choose when I want to get paid. When I'm working a job, I don't, right? My W-2 income gets paid to me every month, and that's it. And so when people are are saying, oh, the tax laws aren't fair. Let's look at, I don't want to politicize, but we can just, in the news right now, Mitt Romney is being criticized because he pays 14 or 15% in taxes, and Obama is paying 28% in taxes, whatever the numbers are. There's this big difference between the two. And the reason that Mitt Romney is able to legally pay less in taxes is, he's able to use these strategies because he's a business owner and an investor. And by choosing what year he wants to take his income, he can actually affect his tax rate.
Yes, definitely. And, another thing to bring up, I know, we're talking about either business owners or real estate investors. It's also important for people to understand that as a real estate investor, you are actually a business owner as well. So for the real estate investors, one of the most common mistakes we see is investors not taking or maximizing their tax deductions. So a lot of the common things like cell phones or traveling and meals related to the investment, discussing investment options and stuff like that. Those are all legitimate business expenses, and so it's really important for anyone on this call. If you're a real estate investor, you are, at least in the eyes of the IRS, for the most part, you're also a business owner, and you might still be working at your W-2 job. You might still, be at home taking care of the kids as well. But you are also now a business owner, and so make sure you take advantage of these related tax deductions, because especially when we're talking about increasing tax rates. Even writing off $100 could mean you saving $30, $40, or even, $50 in terms of taxes. And so, it definitely does start to add up.
That's really powerful on the first property, especially because when people are looking at the tax advantages of owning real estate, usually they just focus on the depreciation schedule. But let's say you are just working a job, and suddenly you add a property. Not only do you get the depreciation schedule of the property, but maybe you can take a portion of your cell phone, maybe you can start writing off some of your investor education, some of your travel, some of your clothing perhaps, some of your home office, maybe some of the cleaning expenses of that home office, etc. So you can start getting very creative about assigning expenses that used to be solely expenses in your life with no deductibility. Now you can start to deduct things that you would have spent anyway. You can start to deduct those because they're usual and ordinary business expenses as part of your real estate ownership business.
Yes, that's exactly correct. And, talking about investment-related strategies, I just want to give you a sneak peek. Later on, sneak peek. Later on, we're going to be talking about retirement-related strategies. And we're going to have Karen Hall, who's going to be sharing ways on how you can take control of your retirement money. But going back to gain harvesting, I love what Matt said about, your ability to sell an investment, pay the taxes now so that you're saving taxes down the road. But I know in speaking with this one particular client just the other day, she has invested in Apple stock. And her question is, well, I don't want to sell. I don't want to sell my Apple stocks. They're doing so well. I want to hold on to them forever. Well, the good news is that, if you sell the stock and you lock in the capital gains to today's rates, there's no limit or, there's no restriction on buying back those same stocks. So you can sell it and immediately purchase those stocks back, and they're still part of your investment portfolio. And, of course, that same strategy you could use with respect to real estate, although a little bit more tricky. Real estate is not something you want to buy and sell in a day or two. But definitely do the analysis to see if it makes sense to you.
Another strategy that people should be looking at is one where we're talking about shifting income, and this is for business owners and real estate investors alike. This is a great way to protect yourself from rising taxes and also protect yourself from the new investment tax of 3.8% that's also coming out next year.
Mm-hmm. I think this is a strategy that people hear a lot about, but I don't see it actually being implemented as often. So I want to kind of maybe share an example of a client Actually, a client of ours, we met with her. She's in the real estate business, and it's kind of unique. She does fix and flips of mobile homes. And what happened was we met with her. It was actually when we went to their house to meet with her and her husband. It was just, chit-chatting. And I said, well, where are the boys? Because I know she has 2 boys in high school. And she said, well, we sent the boys over to one of the mobile homes to have them help us with some remodeling stuff, painting and cleaning up. It was very dirty. The tenant had left it very dirty. And so we said, well, do you pay them? Like, how are you structuring this? And she said, no. They owe it to us. We give them food, we give them clothing, we give them everything. So they're required. It's part of their chores. And so what we did is we talked to them about, well, if you actually put them on payroll, incorporated them into the business, what that means is, let's say, for example, you paid your son $5,000 per person. Well, that means you're getting a $10,000 tax deduction on your tax returns for that year. And if you're going to continuously have your kids help you in your real estate or your business, then you're talking about a $10,000 deduction, if not more, each and every year. And so that definitely adds up. The other way to look at it is, this is probably money you're giving to your kids already anyways, because you're giving them money to go to the movies, you're giving them gas money, you're giving them money to buy back to school stuff. And you're not taking a tax deduction for it, right? So why not legally take a deduction for it by having them help you out in the business and pay them for the work that they're doing for you? You're essentially moving money from your left pocket to your right pocket, and in the meantime, getting a $10,000 tax deduction.
So what you're saying, instead of buying my son toys, I can put him on the payroll, pay him a salary, and let him buy his own toys, and now I've effectively gotten a tax deduction for buying toys for my children.
Exactly. And you've taught him something about responsibilities, about business running, about investing. Isn't that great?
But hopefully they're in that situation, David. You're gonna talk to them about the importance of opening up a Roth IRA and then contributing that money instead of buying toys, right?
Absolutely.
Yes, and Roth IRAs, just kind of touching up on that real briefly, that's actually a really great way, especially for any of you who have younger kids, because think about the tax-free growth potential of that money in a retirement account. You build it up over time, you go out and buy, let's say, a piece of real estate, and your kid potentially could be getting tax-free rental income for the rest of his life. I mean, how amazing is that? And he could pull out some of that to use to pay for college too, and you don't have to worry about limitations of 529 plans and all that other mumbo jumbo. All right, so let's go to the next strategy, and this is whenever we do teaching, whether on webinars or live, legal entity is always one of the most common questions we get, which is what kind of entity should I be operating through? The first caveat I have to say is that, it depends. It depends on your personal situation. It depends on the numbers, and it depends on what you're doing. What is your business, or what are you investing in?
Yeah, and in some situations, it's going to make sense for certain taxpayers to have a multiple entities structure set up. For some people, that's not going to make sense. So just because your neighbor down the street or the person you meet at the seminar or whatever has got 5 entities, that's not going to mean that you need 5 entities. So you definitely need to speak to your advisor and plan proactively about what's going to make the most sense.
But I wanted to talk about entity structuring today, especially with regards to the increasing taxes. Because now for the first time, having different entity structures could make a significant difference on whether or not you're subject to the new taxes. To share an example, I was just working with a new client who came to us, and he's in the consulting business. And he's got a pretty successful business that he currently has set up, where he's probably generating close to about $200,000 a year on consulting income. He also has a bunch of investments, from real estate to land and just other startup businesses. Just so very, very savvy guy who's great at building his wealth. And so he came to us because he was concerned, listening to a webinar, just like how you are right now, when we were talking about the new taxes coming out affecting people who have over $250,000. He said, "Hey, that's me. That's me. I don't want to pay new taxes. What can I do?" so in his situation, we're working with him because he has different investments and consulting companies and all that. We talked about setting up a management company. A lot of times you'll see management companies be set up as S corporations. But because of the new taxes coming out, it actually would be beneficial for him to set up a C corporation instead. The reason being that C corporations pay their own tax rates. And so what that means is if he's able to pay his C corp $50,000 of management fees, now all of a sudden his personal income tax goes below that 250 limit. So now all of a sudden he's not going to have to worry about the new unearned income Medicare contributions tax, nor is he going to have to be worried about the new hospital insurance tax. So that's a really powerful concept to use entities to shift income out of your personal bucket.
Well, and also too in that example, if someone can keep their income in the C corp below $50,000, that's only taxed at 15% for the C corp. Versus if in this example someone's making $250,000, they're probably paying 35%, going up closer to 40% next year for federal. So there's also that tax rate arbitrage that we can take advantage of as well. So
yeah, I mean, on the $50,000 shifting of income between the entities, you're talking about $8,000, $10,000 of savings per year. Because a lot of times too, when you're talking about tax strategy, you don't only want to look at the immediate savings. You want to look at, well, how much is it going to save me each year going forward? So the C corp, a lot of times is a great structure for management companies. Another one that I want to bring up with respect to entity is LLCs. LLCs compared to S corporations, you really need to take a look at that for this coming year. And it's just, it's just the different ways that they're being taxed. S corporations sometimes could be a better result for those of you who have an active business or are actively participating in, let's say, syndications or money raising with respect to your real estate deals. Okay. But entity structuring is fairly complex. Some of the things to note would be that the changes that are impacting you. If you're someone who's over 200 or 250,000 of income, definitely look at ways to use entities to shift a significant portion of that out of your tax return.
Another great point that you're looking about, use of management companies in managing your various real estate entities. For example, we're doing this call today from the state of California, and the Franchise Tax Board charges $800 per entity per year. And so if you've got 4 properties out of state, because I don't know why anybody would buy real estate in California. It's one of the least landlord-friendly states in the country, but that's a digression. If you had 4 properties in 4 different states and you had 4 different entities and you're paying the Secretary of State for each of those states, you're also, if you were personally the manager for all 4 of those entities, you'd have to pay California $800 times 4, right?
Yep.
But if you go ahead. But if you had
that's irrespective of if you make money, lose money, or if you don't even do anything in California. California wants its $800.
That's it. But if you had one company in California that was your managing entity, and that managing entity was the manager of your 4 out-of-state properties, so you created an unnecessary entity maybe from an asset protection standpoint, but now you've got 5 entities instead of 4, only one of those entities is doing business in the state of California, which is your management entity. How many franchise tax fees do you owe? 1 or 5?
Well, that's a great example. In your strategy, that's the cool thing is you only owe the fee for the one company.
And I want to comment, you said, well, now you have an extra entity that you don't really need except for asset protection. I've never spoken with an asset protection attorney who said that having more entities is not good, right? It's like the more asset protection you have, the better it is.
Yeah. But in terms of tax savings, you can take a $3,200 per year tax bill, bring it down to $800 per year by adding an extra entity. And normally that extra extra entity makes things more complicated, but in this case, you're saving a huge amount of taxes. And for example, we do that as part of our tax strategy. We have multiple entities out of the state managed by our California corporation, and we are very careful that we're not bringing that foreign entity into California. We make sure we do our banking outside of California, that any mail that comes to our office, we want to make sure that it's sent to the name of our managing company rather than to the name of the entity, because we really don't want to have that entity do business in California, because that would trigger another $800 per entity.
Right, right. Yes, that's a great point. And, that brings us to the next topic, which is real estate. In the face of rising taxes, for me personally, I feel that it's even more important to make sure that real estate is one of your investment vehicles. As compared to the stock market or other traditional investments, real estate is one of the very few that provides you with, like you said earlier, David, tax-free appreciation, and you get to write off depreciation on the purchase price of that property. And so that's a very powerful concept as compared to, the competitors, which is the typical stocks, bonds, mutual fund, commodities. Now, the other thing that we already touched on is real estate investors, you need to make sure you are deducting business expenses. You need to be in the mindset that you are a business owner. And now all these things, even the fees you're paying to your CPA, I'm sure part of what they're doing is with respect to your real estate business. And so there are better ways potentially to report some of these deductions so that you're able to offset your taxable income. There's a term called the real estate professional status, and contrary to popular belief, this is probably another one of the most common tax mistakes we see. To qualify for the real estate professional status, you don't even need to be licensed as a realtor. There's no licensing required. You just have to meet the number of hours of participation in real estate that's required by the IRS. So why do we care about being a real estate professional? Well, for those of you who are, quote unquote, higher income earners, meaning you're making over $100,000 or over $150,000, you have an opportunity to use the unlimited amount of losses or write-offs on the real estate investments to offset your other sources of income, such as W-2 income, Schedule C income, income from your business. And so it's not uncommon for us to see someone with a $200,000 or $150,000 income to pay either 15% tax or maybe even zero taxes because they could qualify as a real estate professional.
Yeah, we see that all the time. It's a great strategy for people to be able to take advantage of it, because a lot of people don't know about it. A lot of CPAs, they may think they know about it, but don't do it correctly, unfortunately. So.
Yes, and to think about the ability to be able to use all these legitimate business expenses. I think now that you're a real estate investor. Go ahead.
One of the things that made it clear to me, because I was trying to understand why the tax code would be that way, and what I figured out is that if you are a passive investor, the government, or the IRS rather, is trying to limit your ability to take your passive losses and offset your active income. But as soon as you're a real estate professional, your losses are no longer passive. All of your losses are active. And so you can, of course, take your active losses and offset your active income.
Yes, that's exactly right. And isn't it amazing how, I think for all of us on this call today, our goal is to build wealth, right? Build wealth, put our money to work for us so we're not working for our money all the time. But the tax code is written to not promote that. It's written to promote almost like not investing, and instead they want you to actively work for all your income. So it boggles the mind. I'm not sure what the thought process is behind that. But the real estate professional is one of those great loopholes where you can use all the depreciation on an unlimited basis to offset all of your W-2 income.
Well, the tax code is really designed to reward people for investing, right? Because if you have ordinary income, you're paying at a higher rate than if you have passive income, right? The thing that we're talking about is when you have losses, right? The government doesn't want you to take those passive losses to offset your active income because they would lower your tax rate and your the amount of tax that you would pay. But by encouraging people to, by having that loophole, so to speak, it's rewarding people like me who make real estate their business and who are very active investors, and we've given up that addiction called a day job, right? I've heard the most addicting things in the world are cocaine, carbohydrates, and a monthly paycheck. And if you can give up that addiction of your monthly paycheck, you're going to be able to get your income, a lot of control over that income. And so, back to that presidential debate, right? If Obama has been working for his income and his income is classified as W-2 income and he's not investing, then his income rate's going to be higher. And when you look at someone whose income tax rate is lower, I generally think that the person who is paying a lower percentage of their income in taxes is probably contributing a lot of economic stimulus to the economy because they're investing in things. They're putting their money to work in the economy. People who are paying a high tax rate, they just go to work for a living and then they give it all back to the government in taxes. There's no investing happening.
It's true, and it's worth noting too when we're talking about losses on real estate. Obviously, we don't want to incur losses, but the point here is that with a lot of tax strategies you can put in place, you can actually become cash flow positive on your real estate. But with depreciation, with your home office, with deducting meals and things of that nature, we can actually create a loss for tax purposes, and that's where we want to be able to take advantage of that loss to reduce income from other sources, and that's where the real estate professional status comes in handy.
Good point. We never want to lose money just for purposes of getting a tax deduction.
Yeah, if somebody wants to do that, they can send me money, and I'll give you we can give you the tax deduction.
All right, so our next strategy is retirement contributions, and I know a lot of you are anticipating our next speaker, Karen Hall, talk about how to take control of your retirement account. Just real quick, retirement planning is one of the most powerful strategies that you can use to reduce your taxable income. If you're a business owner or if you are active in real estate, you could potentially stash away up to $50,000 or even $100,000 per year to pay towards your retirement rather than pay the IRS. So definitely something to look into. For those of you who are W-2 employees or high-income earners, also look into your opportunity to fund your own retirement account as well. Okay, so just because you have an employer 401k, you might participate in it, that doesn't mean you can't also open and fund other retirement accounts. And so if your goal is to save taxes now, have it grow tax deferred, and also use that to invest in other assets such as real estate, for example, definitely make sure you speak to your tax advisor about that, because a lot of times people don't know they could have a 401k at work and also open and fund their own retirement account. And of course, right now when taxes are still low, this would be a good time to look at putting money into the Roth IRA or Roth 401k. For the first time ever, there's no income limitation to who can have a Roth account, and that, again, that's with the Roth IRA and the 401k. But, we're talking about, okay, how do we put money into our retirement account? And you say, well, great, Amanda, I love that I can put money away, but I don't like the returns. I'm not sure about the stock market. Well, hey, you have options, and there are ways that you can take control of your retirement and invest in alternative assets, such as real estate, trustees, apartment buildings, land, all sorts of stuff. And with that, I'm going to turn the presentation over to our next faculty, which is the self-directed IRA expert, Ms. Karen Hall.
Thank you so much, Amanda. It's great to hear about all the taxes. Yeah, Tax Mageddon. The self-directed IRA, though, is one way to avoid these taxes, of course, because if you've got a self-directed IRA, your proceeds are growing tax-free or tax-deferred, and they're not subject to these new wacky taxes that we've got. I love, the dark brown taxes. But yeah, so my name is Karen, and I'm the president and founder of UDirect IRA Services. And what we do here is we're a third-party administrator, and we provide self-directed IRA accounts. We don't give tax advice, which is so great to have Amanda, though, on hand to give tax advice, Amanda and Matt. We also don't give legal advice, and believe me, we get asked plenty of tax and legal questions, and it's such a close call, but you really need to get tax and legal information from experts, what would you say? You need a collection of good advisors. So what we like to do is help you self-direct, and we can help you from beginning to end. So if you want to change a slide, we'll move on and just say we believe you should invest in what you know best. While we're changing slides, I'll mention something. Amanda was talking about the Roth, but I got a call today, and someone wanted to get a solo pay, and they were talking about the Roth bucket. And I was explaining that with the Roth bucket on a solo pay, the only way to put money in there is to make a contribution. You can't convert money into the Roth bucket, and you can't transfer money from a Roth account into the Roth bucket of a solo pay. You have to do contributions. So that's something important to know. And I think the limit, and Amanda, you can back me up on this, I believe the limit is $17,000 to put into that Roth bucket, assuming that you make enough money, right?
That's correct. So this year, if you participate in a 401k plan, you have $17,000 that you could allocate between your traditional 401k or the Roth 401k, and it's up to you how much you want to put in each bucket.
I see. So yeah, so that's great. So all of these kinds of plans right here can be self-directed, whether you have a typical Roth or a solo pay that has a Roth bucket, a traditional, a Roth, a simple, spousal, even an inherited IRA that's not on this list, that can also be self-directed. But it's not just IRAs. Self-directed IRAs are great, but there's even more. You can self-direct a Coverdell, which is also called an ESA, or an education savings account. That's a great tool. You can save $2,000 a year toward children's education, and that money can be self-directed. An HSA, or a health savings account, is also something that can be self-directed, where you have an HDHP, a high deductible health plan, and you've got to talk to your insurance agent about this, your health insurance agent, make sure you qualify. But if you do, you put the money in, you get a tax break, the money grows tax-free for life, and as long as you use the money for a very long list of benefits, then, or actually I should say healthcare expenses, then the money comes out tax-free. So that's a pretty sweet deal. It's even better than the Roth, I think, when the money, goes in and comes out tax-free. That's the health savings account. So just know that these are all different kinds of accounts that you can self-direct. People will look at our website, and I get this call from time to time, and someone will say, okay, Karen, I'm on your website, and I'm looking here, and it says traditional and Roth and stuff, but I don't see where it says self-directed IRA. So I think that it's important to know that the only difference between a typical IRA and a self-directed IRA is the kind of asset that the plan can hold. The typical IRA is going to invest in stocks, bonds, and mutual funds. But the self-directed IRA can invest, like Amanda was just saying, in anything except life insurance and collectibles, so it's quite a bit. So let's move on to the next slide. And just to say that there are so many different kinds of opportunities. As long as you're investing and your IRA is investing for investment purposes only, and you have no personal use, then you can invest in that. So how do you do this? How do you self-direct an IRA? I say it's as easy as 1, 2, 3. There are more steps than that, but basically there are 3 steps. Step 1 is to open an account. Step 2 is to get money into that account or fund it. And step 3 is then to invest. So to open an account, you go to our website. That's udirectira.com, and open our application. And by the way, the first page of our application is form fillable. So what that means is that you get on there and you see, whoa, that application is 24 pages long. But if you just type on the first page, it's going to auto-populate the entire application. So it's really just one page that you fill out. You give us about 6 pages of that back. You give us a driver's license. There's a $50 setup fee, a copy of the statement where the money's coming from, and then that's great. Well, say, for example, you have an IRA and you're transferring it. That's one way to do it, but here are the 3 ways to put money in the IRA. Number 1 is to write a check and make your annual contribution. Now, people will say, well, Karen, how much can I contribute? And I say, well, call Matt and Amanda, because It depends on your age, it depends upon your account type, and it depends upon your income as well. You could make too much to contribute in some cases. So ask your tax preparer or tax advisor what contribution amount is most appropriate for you. Then you could transfer money. That is from an IRA to an IRA. So self-directed IRA, a typical IRA to a self-directed IRA. Anyway, an IRA to IRA is a transfer. You fill out our transfer form and you sign it. You give it to us and we sign it. Then we send it to your current custodian. And it takes them, right now it's an average of about 16 days to get the money from that current account into your self-directed IRA. But when it gets there, we send you an email. We let you know it arrived. Was it a check? Was it a wire? When is it available for investing? So we've got all that. Now there's another way to put money in the IRA, and that's called a rollover. And what that is when you take money from an employer plan. And by employer plan, I mean like a 401k, a 403b, a 457, from a previous employer. You contact their plan administrator, and then you basically fill out their forms and sign them, and then the money will come over. So those are the three ways to fund a self-directed IRA. But once the money is there, you tell us what you want to invest in. You direct your money. So you give us a direction of investment form. That's our form, very simple to fill out, together with the supporting documentation, and that would be the purchase contract. And with that, now we send the money out in 24, 48 hours, and then you have a self-directed IRA that has an asset. So it's a pretty sweet deal. It's open, fund, and then invest. And of course, all proceeds of the IRA go back into the IRA. All right, skipping on to the next slide. I should say while we're doing that UDirect IRA Services, we've been around now for 3 years. We've opened in excess of 1,100 accounts, and our clients have deposited over $91 million, I believe it is now. So it's going well, and self-direction is just so popular. It's a great way to take control of the money you have in your retirement account and make sure that you're not a statistic. I was in Washington, D.C. in March and learned that that there's a $6.6 trillion deficit between what baby boomers have and what they need to retire. So don't be a statistic. Invest in what you know best and self-direct your IRA into assets that you're comfortable with. And if you want our help, please give us a call. That'd be great. Send an email for questions or anything. khall@udirectira.com. That's my email. The phone number is 866-538-3539. So
one of the great things about self-directed IRA is the ability to hold non-traditional assets, right? If you're just going to be buying and selling shares of Apple, well, then probably any plan administrator would do fine. But if you want to hold any type of a non-traditional asset or a blend of assets, right? Maybe you have some Apple shares and you want a duplex in your IRA, then self-directed IRA makes a lot of sense. And
maybe gold bullion, maybe notes, maybe real estate, maybe mango trees in the Philippines. It can all go in your self-directed IRA.
Yeah, and some people, they want to own real estate, or they want the benefits of real estate, I should say, but they don't want the hassle associated with being a landlord. And that's something that people can look at, is the idea of owning a group investment or a private placement where a company like ours can put together 10 or 15 investors to go pool their money together to go buy a shopping center, and then each person owns a percentage of that group investment. In a situation like that, it functions like a stock, right? What they feel like they own the stock, they get a stock certificate just like they owned Microsoft, etc. But they get all of the benefits of owning real estate. They get the cash flow, the appreciation, the amortization, the tax shelter. Even though they're owning it as passively as owning a stock, they still get their pass-through portion of the depreciation associated with that type of a passive investment. So we've got the opportunity to do some questions and answers right now. If you do have a question for our faculty, you can put it into the chat box right now. If you think of a question later, we have the contact information for our faculty up here on the screen. You can send us an email, visit our website, We would love to be in communication with you if you do have a need for our services. And if you just have a question, I encourage you to reach out to us. Also, I know that there's a lot of investing and, a lot of educational material on all of our websites. Karen, Amanda, and I have a number of video recordings available on previous topics related to real estate investing and tax and using your self-directed IRA. And you can find those recordings, those video recordings, on my website, hassle-free-cashflowinvesting.com. There's a bunch of great educational materials from the faculty.
Well, I think while we wait for questions, David, I just want to say that obviously it's important to keep our pulse on what comes out of this coming election. But really, there's just about 4 months left before this year is over and the tax changes take into effect. And so what a lot of people may not know is that the best time to plan proactively to save taxes is actually now. Because, when you're meeting with your tax preparer or your tax advisor in April at tax time, there's very limited amount of things that they could do for you from a planning perspective. Probably just help you to fund $5,000 to a traditional IRA or something like that. All the powerful ones that we talked about in terms of income shifting or entity structuring or opening up a retirement account where you can put, $10, $15, $20, $30,000 in, those, for the most part, have to be done before the end of the year. And that's same, with if you're on the fence about purchasing real estate as an investment property to generate the cash flow, to get the tax savings, the earlier you take action, the more beneficial it is. And so, it's now is the best time to take action and make sure that you have the right team and the right strategies in place.
A joke that I like to say is in December it's called tax planning. In January it's called tax fraud.
Yeah, I love that. That's exactly correct. For the most part.
So we do have some questions that came in. Chris asks us about a self-directing IRA and what types of things can you not invest in through your self-directed IRA. And in particular, I think he's interested in owning real estate in his IRA, and is that permissible? Karen.
I'll take that one. Yeah, you bet. Well, of course you can own real estate in an IRA, and that's something. Sometimes the self-directed IRA is even called the real estate IRA. Just make sure that it's for investment purposes only, that you're not living in it, or it's not a vacation home. It's not, it's not being lived in by your parents. The lineal ascendants and descendants are disallowed, so they're not allowed to be in there. But when it comes to what your IRA can and can't invest in, the IRS doesn't tell you what you can invest in. They just tell you what you can't, and it's a very short list. It's life insurance, contracts, and collectibles. That's it. Everything else is pretty much fair game.
So basically, you can own real estate as long as you're not getting personal benefit from it outside of your IRA, and that personal benefit extends to your ascendants and descendants. Is that correct?
Well stated, yeah.
Great. Julie's got a great question for Matt and Amanda. Julie's question is, she recently heard from someone that you have to have 6 properties to be able to claim the real estate professional designation. She thought it was time dependent, not property dependent. Matt and Amanda, can you answer that for us?
Yes, and you are very smart, Julie. That's exactly correct. There's no number of properties limitations. What if you owned a multifamily that's just, one property with, 200 units, for example, right? So the requirement, there's actually 2 requirements that the IRS looks for to determine if someone qualifies as real estate professional. The first is that you have to spend at least 750 hours in qualified real estate activities. There's a whole long list of what qualifies. It's, property management, looking for properties, doing the due diligence, doing any accounting, bookkeeping, learning about it, all those things. So 750 hours total for the year. The other requirement is that you have to spend more time in real estate than you do at your other jobs or businesses combined. So what does that mean? Well, that means if you're, let's say you're someone who doesn't have any other jobs or businesses, as long as you spend 750 hours in real estate, you're good. You qualify as a real estate professional. Now, if you're someone who works, let's say part-time, and you work 1,500 hours a year, that means you have to have at least 1,501 hours in real estate, and you would qualify as a real estate professional. If you're someone who works full-time at a job, let's say 2,000 hours, then you have to have 2,001 hours to qualify as a real estate professional. The other thing that's commonly overlooked is that the real estate professional status could be claimed by either husband or wife. Okay, so if you're someone who's working full-time at a job and you have, a few properties that you're investing in, but your wife is a stay-at-home, well, the strategy would be to have your wife try and qualify as a real estate professional. As long as one of you qualifies, both of you get the tax benefit. So you can use the real estate loss to offset your W-2 income. And I say wife, but obviously it could be a husband who's the one that stay at home and the wife is working full time. So
when I'm doing personal investment strategy consultations with our clients, very oftentimes I'll see a very high income person married to someone who's making a lower income, and they own property. And sometimes when I help them do the math of if that lower income spouse quit their job and just did 750 hours of real estate activities, they would actually make, or I should say keep, more money because they get to claim that tax shelter and the reduced cost of commuting, the reduced cost of child care, the reduced cost of meals away from the homes, et cetera, that they wind up saving more money by quitting their job.
yes, and we see that all the time. A common scenario is they'll say maybe the one of the spouses will say, you know what, I'm not interested in real estate. My significant other does real estate. But when you show them the numbers, and all of a sudden they say, I can quit my job and have more money, so yes, now I'm interested in real estate.
Well, we've come up to the end of our hour together, and I really appreciate everyone for being on this call. If we did not get to your question, feel free to send us an email directly to the faculty you think would best answer that question. If you like today's webinar, the best way to say thank you is to tell a friend. We do these webinars quite frequently and really encourage you to share this educational resource with your friends and family.